Picture this. It's a Sunday morning. You're sitting at your kitchen table, coffee in hand, scrolling through your phone, and you see a notification from some news app you forgot you downloaded. The headline says, "Housing market sees biggest shift in 5 years." You stare at it for a second, and then you do what most people do. You scroll past it. Maybe you think, that's interesting, in the way you think something is interesting but don't actually care enough to click. Maybe you assume it doesn't apply to you. Maybe you figure you'll look into it later, and later turns into never. Now fast forward 12 months. You're talking to a friend, or a coworker, or a cousin at a family dinner, and they mention, almost casually, that they just bought a home, or that they refinanced at a surprisingly good rate, or that they locked in a deal in a neighborhood that's now absolutely exploding in value. And there it is, that feeling, that quiet, uncomfortable feeling in your stomach that says, wait, did I miss something? You did. Most people did. And here's what makes this so frustrating. It wasn't hidden. The information was right there. The shift was happening in plain sight. But because of the way the human brain processes risk, uncertainty, and big financial decisions, most people looked directly at the signal and walked away from it. Today, we're going to fix that. We're going to break down exactly what just changed in the housing market, why it matters more than most headlines are telling you, and what the people who are quietly building wealth right now are actually doing about it. Because this isn't just a real estate story. This is a story about how the decisions we avoid, the ones that feel uncomfortable and uncertain and complicated, are almost always the ones that determine where we end up financially. Stay with me, because by the end of this video, the way you see the housing market, and honestly, the way you see big financial decisions in general, is going to be completely different. Let me ask you something honestly. When you think about buying a home right now, what's the first feeling that comes up? For most people, between the ages of 20 and 40, the honest answer isn't excitement. It isn't confidence. It's something closer to exhaustion mixed with resignation. Because for the last several years, the narrative around housing has been relentlessly discouraging. Prices went up, then rates went up. Then prices stayed high, even though rates went up, which apparently wasn't supposed to happen, but did anyway. First-time buyers got priced out. People who waited for a crash watched prices stay stubbornly elevated. The dream of homeownership started to feel less like a milestone and more like a moving goalpost. And so a very understandable belief took root in an entire generation of people. The belief that the housing market is rigged, that the window has closed, that the only people who can build wealth through real estate are people who already have wealth, or people who got lucky and bought 10 years ago, or some mysterious category of people who seem to just know things that the rest of us don't. That belief, it feels logical. It feels justified by everything we've lived through. But it's also costing people enormous amounts of money, opportunity, and long-term financial security. Not because it's entirely wrong, but because it's a story that's stuck in the past. It was written during a specific moment in time, and too many people are still reading it like a current headline. Here's the thing about beliefs around money that nobody really talks about. Once they form, they're incredibly sticky. Psychologists call this belief perseverance. It means that once we've decided something is true, we unconsciously filter out all the information that contradicts it and only notice the information that confirms it. So if you decided 2 years ago that the housing market was impossible, you're now walking around with a filter over your eyes that makes you keep seeing evidence that it's impossible, even when the situation has genuinely changed. The problem is that most people are so deep inside the old story that they can't see the new one unfolding right in front of them. So let's actually look at what's changed. Not through the lens of panic or hype, but just honestly, with clear eyes. To understand the shift, you need to understand what was happening before the shift. So let's go back a little bit. Between 2020 and 2022, the housing market went through something genuinely unprecedented. Interest rates hit historic lows. We're talking rates that hadn't been seen in decades. Borrowing money to buy a house was incredibly cheap. And what happens when borrowing is cheap? Demand explodes. People who were on the fence jumped in. People who weren't even thinking about buying started thinking about buying. Investors piled in. And because supply, the actual number of homes for sale, couldn't keep up with that demand, prices went up fast, like shockingly fast. Then came 2022 and 2023. To fight inflation, the Federal Reserve raised interest rates dramatically. Mortgage rates, which had been sitting around 3%, climbed to 6, 7, even close to 8%. And here's where something fascinating and counterintuitive happened. You think that higher rates would crash home prices. Less demand, right? Fewer buyers who can afford the higher monthly payments. So prices should fall, but they didn't. Not meaningfully. And the reason why tells you a lot about how real estate markets actually work. Think about a homeowner who bought their house in 2020 or 2021 when rates were 3%. Now rates are 7%. If they sell their house, they give up that 3% mortgage forever. They would have to take a new mortgage at 7%. So even if they want to move, even if their house is appreciated in value, selling feels like a financial punishment. So they stay. They don't list their home. They don't add supply to the market. Economists gave this a name. They called it the lock-in effect. And what it created was a frozen market. Prices stayed high because there wasn't enough supply. But sales volumes dropped dramatically because buyers couldn't afford the payments and sellers didn't want to move. The market was stuck. Now imagine you're a first-time buyer during all of this. You're watching from the outside. Prices are still high, rates are high, inventory is low, competition for anything reasonably priced is still intense. You look at the market and you think, this is broken, I'll wait. Completely reasonable conclusion. Based on the information available at that time, waiting made a lot of sense. But here's where things start to get interesting. Because that frozen market couldn't stay frozen forever. Life has a way of thawing things out. Think about what keeps a market frozen. It's when sellers have no reason to sell and buyers have no reason to buy. But sellers always eventually have reasons to sell. Not financial reasons, life reasons. People get divorced. People lose jobs or change jobs. People have children and need more space. People's parents get older and they need to relocate. People retire and want to downsize. These decisions don't wait for the perfect interest rate environment. They happen on life's schedule, not the market schedule. So what started happening quietly in the background was that inventory started rising. Not dramatically, not overnight, but the number of homes for sale started creeping up, month by month, slowly but consistently. And at the same time, something shifted in the psychology of sellers. After 2 or 3 years of holding on, the fatigue set in. The people who had been waiting for rates to drop back to 3% started realizing that might not happen anytime soon. Motivated sellers began accepting that reality and deciding to sell anyway. Now here's why this matters so much. When inventory rises and motivated sellers appear, the balance of power shifts. You go from a seller's market where buyers are competing against each other desperately for limited homes to something closer to a balanced market or even a buyer's market in certain areas. Sellers start offering concessions. They pay closing costs. They drop prices. They negotiate. They accept contingencies they would have laughed at 2 years ago. Simultaneously, mortgage rates started pulling back from their peak. Not crashing back to 3%, let's be clear about that. But moving from nearly 8% down towards 6.5%, 6%, in some loan types even lower, which sounds small, but mathematically it makes a meaningful difference in monthly payments. And perhaps most importantly, buyer competition dropped significantly. The speculative frenzy of 2021 is over. The investors who were buying 10 properties at once have largely pulled back. What's left in the market is a smaller, more deliberate pool of serious buyers. Less noise, less panic, more room to think. So when you add it all together, more inventory, more motivated sellers, less competition, moderating rates, what you actually have is a market that is meaningfully different from what it was 18 months ago. Not perfect, not easy, but different. And for people who are paying attention, genuinely full of opportunity. Here's where I want to get into the part that most finance videos skip over. Because understanding what's happening in the market is useful. But understanding why you might not act on it, even when you know that's what actually changes your financial trajectory. Let's talk about the psychology of big financial decisions. And I want to walk through 3 specific mental patterns that are keeping people on the sidelines of this market right now. not because they lack intelligence or information, but because these are baked into how human brains work under conditions of uncertainty. The first one is called anchoring. Anchoring is when the first number you're exposed to becomes the psychological reference point you use to evaluate everything else. And in housing, this is absolutely everywhere. If you saw homes in your city selling for $250,000 in 2018, that number is imprinted in your brain as the real or fair price for a home. So when you see homes listed for $400,000 today, it feels offensive. It feels wrong. It feels like being ripped off, even if wages have risen, even if the area has grown substantially, even if the cost of construction materials has permanently changed the economics of building new homes. The anchor from the past distorts your perception of the present. And here's the thing, anchoring doesn't just affect how you see prices. It affects how you see opportunity. People who are anchored to the ultra-low rates of 2020 look at a 6% rate today and say, that's terrible. But compare that same 6% to the historical average mortgage rate over the past 50 years, which is actually closer to 7.5%, and suddenly 6% doesn't look so extreme. It looks slightly below average. The problem isn't the rate. The problem is the anchor. The second pattern is loss aversion. This is one of the most well-documented phenomena in all of behavioral economics, and it goes like this. Humans feel the pain of a potential loss roughly twice as powerfully as they feel the pleasure of an equivalent gain. What this means in practice is that if you're considering buying a home, the fear of buying at the wrong time, of watching the value drop, of feeling like you paid too much, is felt twice as intensely as the potential upside of buying at a good time and building equity over years. So your brain is running a calculation that's fundamentally biased. It's weighing the downside twice and the upside at face value, which means the rational version of the decision, the one that actually accounts for realistic probabilities, almost always feels more risky than it actually is. Loss aversion is why people who have been waiting for a crash since 2021 are still waiting, even though the opportunity cost of not owning, paying rent, not building equity, not benefiting from the inflation hedge that real estate provides has already been enormous. They're so focused on the loss they're trying to avoid that they can't see the losses that are already accumulating by doing nothing. The third pattern is what I call status quo bias, or more simply, the comfort of inaction. Doing nothing always feels safer than doing something, especially when the something involves a large, irreversible commitment. Buying a house is about as large and irreversible as it gets. So the brain defaults to, let's wait, let's see, let's gather more information. And here's the cruel trick that status quo bias plays on you. No matter how much information you gather, there will always be more uncertainty. There will always be another variable to worry about. The market could shift, rates could move, something could happen geopolitically. There is literally never a moment where all uncertainty disappears and buying a home feels completely safe and obvious. That moment does not exist. The people who build wealth through real estate are not people who found certainty. They're people who learn to act intelligently in the absence of it. Now, let me tie all three of these together with a concept that might reframe how you think about the housing market entirely. Imagine two people. Let's call them Maya and Jordan. Maya is anchored to 2020 prices. She's loss averse. She's been waiting for rates to drop back to 3% and prices to fall 30% before she buys. She keeps saying she'll wait and see. Jordan understands what's happening. He knows rates aren't going back to 3% anytime soon. He knows prices in his market have actually stabilized and in some pockets dropped modestly. He knows that motivated sellers are making deals. He's less focused on buying at the perfect moment and more focused on buying the right property at a fair price with terms that work for his life. So he does the work. He gets pre-approved. He finds a neighborhood where values are supported by real demand, good schools, job growth, infrastructure, investment. He makes an offer. He negotiates closing cost assistance because the seller is motivated. He gets the house. Is Jordan's rate perfect? No. Are prices exactly where he'd like them? Not exactly. But does he now own an asset that is appreciating, that someone else isn't charging him rent to live in, that he can refinance if rates drop in the future, and that in 20 years will likely be worth significantly more than what he paid? Yes, to all of those. Maya, meanwhile, is still waiting. And every month she waits, she's paying rent that builds someone else's equity. She's missing the tax advantages of homeownership. She's missing the forced savings mechanism that a mortgage creates. And she's watching the window of moderating competition and motivated sellers slowly close as the market rebalances. The difference between Maya and Jordan isn't knowledge. They both understand the market equally well. The difference is that Jordan understands his own psychology well enough to not let it make the decision for him. That's the real insight here. The housing market changed. But the bigger change that needs to happen for most people is internal. So what do you actually do with all of this? Let me be direct. I'm not here to tell you to go buy a house immediately. I'm not a financial advisor, and this is not personal financial advice. Real estate decisions depend heavily on your specific situation, your income stability, your savings, how long you plan to stay in an area, the specific market you're in. Those details matter enormously. But what I can do is give you a framework for thinking about this more clearly. 5 things to actually consider. Number 1, stop measuring the market against the past and start measuring it against your life. The question isn't whether rates are better or worse than 2020. That's irrelevant. 2020 is gone. The question is, given your income, given your savings, given your life goals, does buying a home at current rates and current prices make mathematical sense for your situation? Run the actual numbers. Compare your monthly mortgage payment to your current rent. Factor in tax deductions, equity building, and the predictability of a fixed payment versus rising rents. You might be surprised by what the math actually shows. Number 2, pay attention to your specific market, not national headlines. The housing market is not one thing. It's thousands of local markets, each with their own dynamics. The city where your cousin lives might be cooling off. The neighborhood you're eyeing might still be competitive. National headlines are almost useless for making personal real estate decisions. What you need is hyper-local data. What's the average days on market in the area you're considering? Are price reductions happening? Is inventory up or down compared to 6 months ago? That information is available, and it's much more useful than anything you'll read in a general news article. Number 3, understand the refinancing option. One of the most important things people misunderstand about buying at a higher rate is that your rate today doesn't have to be your rate forever. If you buy at 6.5% today and rates fall to 5% in 2 or 3 years, you can refinance. Your home equity stays, your appreciation stays, but your payment can drop. There's an expression that people who understand real estate live by: marry the house, date the rate. The house is the long-term commitment, the rate is temporary. You can change it. And in a market where motivated sellers are more willing to negotiate, you might even get the seller to contribute to a rate buy down at closing, which effectively lowers your rate from day one. Number 4, get pre-approved before you're ready to buy. This one sounds logistical, but it's actually psychological. Most people don't get pre-approved because getting pre-approved feels like a commitment, and they don't want to commit until they're sure. But this backwards. Pre-approval is information. It tells you exactly what you can afford. It tells you how lenders see your financial profile. It might reveal things you need to fix your credit score, your debt-to-income ratio, your employment documentation. And when you find a property you want, it puts you in a completely different category as a buyer. Sellers take pre-approved buyers seriously in a way they simply don't take unverified interest. Number 5, think in decades, not months. This is maybe the most important thing I can say. Almost every major study of long-term housing values shows the same pattern. Over 10, 15, 20-year periods, well-chosen real estate in markets with real economic activity appreciates. People who bought in 2007, right before the financial crisis, felt terrible for several years. But the ones who held on and didn't sell at the bottom came out fine, and often very well, by 2015, 2017, 2020. The people who bought in 2008 during the crash, when everyone was terrified and the headlines were apocalyptic, many of them became quietly wealthy by the time 2015 rolled around. Timing the perfect moment is a fool's game. But entering the market at a fair price, in a market with genuine long-term demand, and holding for the long term, that strategy has a very strong historical track record. Now, with all that said, I want to be clear about something. Not everyone should buy a house right now. If your job is unstable, if you might need to move in 2 years, if you haven't built an emergency fund, if your credit needs work, those are real reasons to wait, not psychological reasons. Real, practical reasons. Take care of those things first. But if those things are in order, and you're waiting because you feel uncertain, because you're anchored to past prices, because you're afraid of making the wrong decision, understand that those aren't reasons. Those are mental patterns, and they can be worked through. Let me leave you with something to think about. There's a study I keep coming back to when I think about financial decision making. Researchers looked at people who made major purchases or investments at what felt like bad times, recessions, high rate environments, aftermarket corrections versus people who waited for better conditions. And what they found wasn't that one group always made more money than the other. What they found was something more interesting. The people who acted even imperfectly in conditions of uncertainty developed something the waiters didn't. They developed financial confidence. They learned from doing. They made adjustments. They got better. And over time, that confidence compounded in ways that were almost as valuable as the financial returns themselves. The people who waited for perfect conditions, many of them were still waiting years later, because perfect conditions don't exist. And waiting for them is just a way of letting fear make your financial decisions for you while you tell yourself you're being smart. The housing market just changed. Not into a perfect market, not into the market of 2020, but into something different from what it's been. Something with more room for thoughtful buyers who are willing to do the work, understand their numbers, and make decisions based on logic, rather than on the lingering stories their brain is still telling them about a world that no longer exists. The question isn't whether the market will ever be perfect. It won't be. The question is whether you'll be ready when the next window opens. Because windows open. Most people don't notice. Some do. And some of those people, the ones who notice, who pay attention, who act thoughtfully in the absence of certainty, some of those people are quietly building the kind of financial foundation that 10 years from now will look obvious in hindsight. Don't be the person who scrolls past the notification. If you found this useful, the single best thing you can do is share it with someone who you think needs to hear it. And if you want to keep going deeper into how money, psychology, and wealth building actually work in ways that actually make sense for real people living real lives, subscribe, because we have a lot more coming. See you in the next one.